All right. Hello, everybody. Welcome to day two of Topstep's Trading Foundation Basics. Today, we're going to be talking about the contract leverage and our role as a speculator. We've got JD, the dancing bear, with us today. You can see there. You can see us on camera today. We've set that up so you can see us. We got Jack P right there. Hello, Jack. It's
Hey,
good
John,
to see
what's going
everybody.
on?
You see all the folks we've got from all over the world here. We got Croatia, we've got South Africa, we've got Germany, we've got Brazil, we've got Houston, Texas. We've got lots of folks, and we really appreciate you all saying hello and letting us know that you're here. And we're excited to have you with us today, of course. San Diego, London, Manhattan, Mars. We got somebody here from Mars, Buffalo, Finland.
Sick. Nice.
Wow,
So, Hogue, before we get started, I thought I'd just
Yes.
give a little bit of housekeeping at the top. We had maybe 50 to 100 people ask yesterday about recordings. You should have all gotten an email from you signed up for this course. We sent it out at like 11. That has a link to a page where we're posting the recording. So you'll have yesterday, and we'll try and have today's up by the end of the day, at the latest tomorrow morning, just because it takes time to download from here, upload back to YouTube and all that jazz. But the recordings are available. And
Awesome.
also we may turn off the comments in the middle of the presentation, just because, there's a lot of us here. It goes by pretty quick. And, we love a good heckling, a good trolling, but, keep it at a minimum. You all seem nice. So I'll leave it up to you, Hogue. Yeah, who's that guy yesterday, by the way? Angelo or something? Is he back?
Yeah.
Hi, dude.
Who knows?
Yeah, a lot of anger in this
not,
world. Anyway.
Don't see him here.
Perfect. Good. All right, Hogue, we'll hand it over to you. I'm going to turn off my camera, probably you, JD, too, so you guys just don't see us sitting here reading questions and comments. It's just disnerving. So we'll turn off our cameras now and let Hogue do his thing.
All right. Thank you, guys. And again, thanks to all of you for joining us. There's so much information available in trading and so much about trading that we just wanted to start and really start with the foundation, the basic knowledge that you need if you're going to be a futures trader. And today, again, we're going to be talking about the contract, what leverage is, and talk a little bit about our role as a speculator. I don't expect this to last more than 25 minutes or a half an hour. We don't want to keep you too long. So we'll jump right in. As if you weren't here yesterday, I got to introduce myself here again. My name is John Hoagland. I'm the middle-aged performance coach here at Topstep. And in February, it'll be 39 years for me in the futures trading industry, not necessarily all of them actively trading, more like 30 or 31 years of that. Did trade on the floor of the Chicago Mercantile Exchange as well as other exchanges for over 20 years. I come from a long line of traders. My dad was a futures trader on the floor of the Chicago Board of Trade for 40 years. My brother was in the industry for a period of time. And my dad's dad was a cash grain trader in South Dakota, Iowa, and Nebraska before that. So we go about 100 years. We are not the Duke brothers by any stretch of the means, but we've been around, and I just want to, help traders in any way I can. I had to migrate to screen trading. I stepped out of the pit for the last time in 2009 and spent a year kind of relearning trading on screen. Started trading on screen in 2010 and hooked up with Topstep and the folks here at Topstep at 2011 because I fell in love with the idea. Before the pits went away, you had the opportunity to get a job on the trading floor and to learn the industry in a safe way from professionals, and that's no longer available. So that's one of the reasons that I do love Topstep and that I enjoy, the opportunity to talk to, help, and work with traders from all over the world, and I've talked to thousands of them. And as we go through this foundation, we're going to be talking a lot about the things that I've learned as a trader and that I've learned from the people that I've worked with, because nobody knows everything in trading. You'd think after 39 years, I might be pretty close, but I don't believe that to be true. There's always more to learn. Markets are always changing. When you get the right answer, the market's going to change the questions, and 1+1 doesn't always equal 2. So starting at the basics, I think, is an important thing. We did the history of futures trading yesterday. Hope you enjoyed it. It was just a kind of a warm up for the things that we're going to be looking at and talking about over the next 4 weeks. All right, so the futures contract, by definition, it is a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or financial instrument, at a predetermined future date and price. When we think about a contract, there's always 2 parts to the contract. You can't have a contract. Well, I guess you could have a contract with yourself. You could call that a New Year's resolution. But in this is business, and there's always 2 parts to the contract. There's a buyer and a seller. The way the contract system works and the way it benefits those that use these markets to hedge is the fact that there's several contracts that are set to expire at specific points in the future for when you're going to expect to and need to deliver or take delivery of your product, or if you're just going to liquidate the contract. The thing that strikes me about this is the binding agreement. The futures contracts are going to, of course, detail the quality and quantity of the underlying asset. They're going to standardize those contracts to facilitate trade on a futures exchange. Some futures contracts may call for physical delivery of the asset. If you're thinking about grains or meats or crude oil, for example, those are deliverable products, and they are set to be delivered upon expiration of the contract. That's the part that makes it scary to think about the binding agreement. Others are settled in cash. If you take a contract of S&P's past delivery, you're just going to have to either take the cash if the settlement is in your favor, or pay the cash if the settlement is not in your favor. One of the things we're going to be talking about today is the leverage, and futures markets are characterized by the ability to use very high leverage relative to stock markets. So kind of going back to the futures contract, that it's that obligation that scares me, but we don't have to worry about that as long as we keep track of our position. If at the end of the day, we want to go home flat, we have to have the same number of buys and the same number of sells to have no position and no obligation. If I trade 10 by 10, I have 10 buys and 10 sells at the end of the day. I don't have any position, and I have no obligation to make or take delivery of the products. As long as traders are what's considered flat by the end of the day, if you want to go home flat at the end of the day, or more importantly, by contract expiration or first notice day, you won't need to store 5,000 bushels of corn in your yard or 1,000 barrels of crude oil in your swimming pool. First notice day is something that we don't talk about much because there aren't that many traders that trade products that have a first notice day. Grains will have a first notice day, and that is if you are still holding a position in a grain contract past first notice day, at any time you can get a warehouse receipt notifying that you are to deliver or take delivery of the position you have. Again, we don't have a lot of grain traders, but it's something to be watching for our grain traders. As a matter of fact, something to be watching for tomorrow for our grain traders is I believe tomorrow is the crop production numbers at 11 o'clock. So if you are trading grains, watch out. Tomorrow can be a very volatile day. But if we're flat, we have no obligation and no risk. So when we think about the futures contract, there are several ways to, of course, benefit from using the futures contract. They can either be used to hedge or, they can either be used to hedge or speculate on the price movement of the underlying asset. For example, a producer of corn could use futures to lock in a certain price and reduce the risk or transfer the risk by using that hedge to ensure that at the very least they're going to be able to sell the corn at that price at that specific time in the future. And on the other hand, then this pertains to all of us, you could speculate on price movement of corn by going long or short futures. Of course, we are all aware of that. If we're traders, we're already doing that. So the futures contract, again, a binding agreement, but again, don't let that make you nervous. Just make sure you're flat at the end of the day or at the end of the contract life. It lowers credit risk because the exchange guarantees the execution of all the contracts, and it's going to make sure that there is a standardized level of quality for the products. You have to have the ability to have standardized contract specifications. And I'm going to show you how to find contract specifications as we go through this today. Of course, centralized clearing is part of the ability of the exchange to make sure that all contracts are executed as they should be. And again, leverage. Leverage is what makes these products, futures and Forex products, so risky and or so profitable. Now, when you think about a futures contract, a lot of folks that don't know what we do, you all probably have friends that say they know you're a trader, and they may know or may not know about futures trading, but they tend to judge everything by what the stock market does. The stock market's up, everybody thinks we're all going to make a bunch of money. If the stock market's down, they all think we're going to lose a bunch of money, and nothing could be further from the truth, even when we're trading stock index futures. Stocks are ownership in a company. Stocks can create value. If you were smart enough to buy Apple, so many years ago, you got a pretty good whiff of what it means to have a stock that you own create value. It actually creates money for you. Futures do not create value. There is a transfer of risk, not a value creation. So for every long, there's a short. Forex is not necessarily like that. Forex, you can be long and short the same pair. And if you do it right, there are some benefits to that, but you're going to have to get out of the long and get out of the short. Futures, again, no value creation. For every long, there is a short. We are going to be talking about that as we go along through these foundations. In week 3, we're going to be talking about volume and open interest, and what open interest is. The total number of outstanding contracts. One long, one short equals one contract. So when we talk about leverage, some people talk about it like your broker loans you the money over and above what the total cost is for the contract that you're trading. The use of various financial instruments on or borrowed capital, such as margin, to increase the potential return of an investment. Remember, futures is a zero-sum game. There's no value creation. For every dollar earned, a dollar is lost. When you take all of the futures contracts at the end of every trading day and you look at the balance sheet of how much money was made and how much money was lost, it comes to zero. I think this is one of the reasons that this is so difficult, is because there is no value creation. For you to make money, somebody has to lose it. Don't feel bad about that. Believe me, those that are playing would be happy to take your money. So when we think about leverage, we got to think about margin. When we think about a futures contract, let's say the crude oil contract, we're going to take a look at how to find the contract specifications on the CME website shortly. But currently, the maintenance margin to hold one contract of crude oil is about $5,850. Now, if you're a day trader, you're not going to have that maintenance margin up. But if you are holding positions at any time the market is closed, even if it's from 4 p.m. Central to 5 p.m. Central when the market is closed, you're going to have that margin up. It is to protect your clearing firm as well as the exchange from things that may happen, where they could create situations where you could lose more than you have in your account. Okay, so let's look at the crude oil contract specifications. The CME Group website is absolutely fantastic to find all this information out. It takes a little time to learn to navigate it. I've got it right here with the crude oil contract specifications. I'm going to look a little bit deeper into this. I just wanted to put this on the slide to show you that the contract specification, one contract of crude oil is 1,000 barrels. If you've ever seen a train car that says oil or crude oil on it, 1,000 barrels fills up about 1 1/3 of those train cars. When you see those long train cars with crude oil cruising down the track, the price quotation is, of course, in US dollars and cents per barrel. 1 penny move is $10. It's $1,000. Makes sense, right? But if the contract is 1,000 barrels and crude oil is currently trading $81, that's $81,000 of value that you're getting for the low discount price of $5,850 in margin. So when you hear stories about traders that have made millions of dollars, it's not just that they were in the right place at the right time. They had the money to facilitate those positions by having enough in margin. More true now than at any time in history. The clearing firms with electronic trading know your position, everything about your trading in the blink of an eye. In the early 70s, the books were a little bit behind. You could probably get away with holding a position greater than you were margined for a brief period of time. And there were those that took advantage of that. So I want to bring pardon me. This is the CME Group website. Excuse me. The best thing that I can do is I can just go and search. You can see the searches I've already had. Crude oil contract specifications. I'm going to click there. I'm going to click here. And if we can get this to load, we're going to see a lot of information about the crude oil contract, an overview, quotes about the contracts, settlements, volume, and open interest, something we're going to be getting into as we move along, time and sales, specifications, margins, contract specifications. What we just really looked at, 1,000 barrels, dollars and cents per barrel, 1 cent per barrel per tick, $10. We are all well aware of that. And it is a deliverable product. Termination of trading, important to know, 3 business days prior to the 25th calendar day of the month prior to the contract month. We know that crude oil rolls over every month. And if you were around about a year ago, last May, you saw the price of crude oil go below zero. It's a deliverable product, and nobody had any place to put it. Never know what's going to happen. And if they ever tell you that the price can't go below zero, don't believe them. It gives you the ticker code CL1, CL2. We all know, hopefully, the contract months. Maybe that's something I should add to one of these presentations. But we know that we're in Feb crude. Feb G is the contract month specification for crude oil. So now let's go and we'll take a look at margins. Crude oil between December of 21 and February of 22, we're looking at 5,800 in maintenance margin per contract. So if we were to be holding positions, let's say we were going to hold 10 contracts, which is $800,000 worth of crude oil, we could do that with only $58,000 up. That's the beauty of leverage, and that's the danger of leverage. Let's look now at the E-mini S&Ps. E-mini S&P. How do we find the nominal value of the S&P? Well, the E-mini S&P 500 is 50 times the price. So if we were to look at the specifications, you can find here the contract unit, 50 times the S&P 500 index. Dollars and cents per index point. We know it's 12 and a quarter a tick. Ticker is ES. Financially settled in cash. Gives you the termination, terminates at 9:30 a.m. on the 3rd Friday of the contract month. It's the 2nd Thursday that we switch positions if you're used to trading the E-mini S&Ps. So assuming that the index is trading 4680 times 50, we're looking at $244,000 worth of a basket of stocks. What's the margin on that? Maintenance, 11,500. Just to hold one E-mini S&P, you're going to have margin in your account of 11,500. But that's a pretty good nominal number there, 4680. If you're going to be holding a little over $250,000 in a basket of stock, if you're not going to be holding it overnight, you're not going to have that much margin. Like, again, the beauty and the risk of leverage. So we know there's a lot of different players in these markets. There's hedge funds, there's banks, there's speculators of all time frame and size. When we think about the players, we're thinking about the producers. Probably easiest to think about an agricultural commodity. The producer would be the farmer or the cattle rancher or the oil man digging oil out of the ground. They're going to be watching price over time to try and produce and protect the highest price available for their product. We talked yesterday about the corn farmer that was, thinking here in January, boy, if corn was $4 right now, I could probably do a pretty good job of making some money come harvest time, which isn't until the fall. That's the way these producers use these markets is to protect themselves and transfer the risk of consumers or users are always going to be trying to protect the lowest price for their needs. If I'm Kellogg's and I need a lot of corn to produce my cornflakes and frosted flakes, I'm going to try my darndest to make sure I can get it as cheap as possible. Be watching the market to see where the lows are and seeing if I can accumulate a position and earn money in my futures position while I'm waiting for delivery of future contracts of corn. And then there's the speculators. That's us. And our job is to try and make money off of price changes. That's what we do. And why are we here? Who are we and who are we here? There are, again, speculators of all time frames and risk appetites, size, money. If you're a retail pea shooter like me, you don't really make all that much of a difference. But we do provide a role to the marketplace. The speculator's role is to provide liquidity. More speculators, more opinions. The more speculators you have in a market, the closer the bid and the offer are going to be. More speculators means a thicker market, and thicker market makes it easier for the bigger traders to be able to execute large orders of contracts without moving price too much. For this service to the market, we have the opportunity, not a right, we have an opportunity to profit from that price movement. But our real job is to facilitate trade. Now, a lot of scalpers used to do that in the trading pits. They'd be on the bid and on the offer, and they would take whatever trades were available and try and make money in really small ways. That niche is largely taken over by computers. We're looking for, at least I'm looking for a little bit bigger bites out of the market than I used to in the trading pit. But again, we're not here just because they want us here. We're here because they need us here. If we take a look at two different domes, here's the dome in the S&P is providing liquidity. Again, more speculators, more opinions. When we're looking at the dome in the S&Ps, we can see that there's, tens, if not hundreds of contracts on each price, on the bid and on the offer. This is a relatively mature and thick market. Looks a little thin today, but we've had some recent volatility that tends to thin out the market. But now look at the NASDAQ. We have single digits of bids and offers. This is not a very thick or liquid market. If I was a bigger trader and I wanted to sell 100 contracts at the market, I could move price just a couple of ticks. If I were a larger speculator or hedger and I wanted to move 100 NASDAQ and I did it all at once, I would move them. I would move the market. Let's see, at least 12 to 15 ticks, if that, if not more. One of the things about the thickness of a market, if you've ever had a stop slip past, if you've ever, if you've ever had a stop and it didn't get filled at your price, got filled at a worse price, that's also something to be considering. That slippage is directly related to the liquidity of that product. If you have a very thin market and the offers dry up and you hit your stop, you may have to pay considerably higher for your buy stop. You may not have the same situation here in the S&Ps, but you are likely to have some slippage once in a while. And the slippage is, if you have a stop above the market and the market gets there, as soon as that price trades, that becomes a market order if you're doing it right. There are two different types of stops, and we're going to talk a little bit about those tomorrow as we talk about the trading platform. If you're using stop limits or stop same limit, try not to do that. Use stop markets. If the price gets to a point of invalidation, you're going to want to get out. You want to get out. And if you don't have enough liquidity in your market, your stop, let's say you have a buy stop right here at 15,714 and you get your stop hit and there's nothing on the offer, your order is just going to turn into a bid and sit there and wait for the market to come back to fill that bid. It leaves you completely, if you pardon the expression, naked to the market. Your stop did not get filled. You're wide open to any losses that can occur. Okay, so that's kind of our look at the contract, the leverage, and the role of the spectator in futures trading. I hope that you've learned something. If you don't think you learned something that you're going to be able to use today, I'll bet you at some point in the near future, you're going to say, Hope was right. I didn't know that. And now it's becoming useful to me. So, nobody knows everything, of course. I certainly don't. Why I love doing these, because I learned probably more from all of you than you might learn from all of me. So if you haven't yet, check out our YouTube channel. I'll put maybe we can put the link in the chat at some point here, but it's youtube.com/user/TST Squawk Radio. You'll get all kinds more content for you. The market forecast at 7:45 in the morning, the recap at 3 o'clock. We just did Coach's Playbook. We're talking about range bound trading. We have the ability to ask questions of our founder, Michael Patak. We've got funded trader interviews, market therapy. It just never ends. The availability of the content and your opportunity to learn here at Topstep. As well as always, we're looking for your success. Jack, how are we doing?
We're doing great. I've been hacking away at the keyboard, trying to answer questions in the Q&A. And I see a few in here too. Yeah, thanks for the thanks. Is attendance being tracked for the certificate? We're trying to. We're going to be flexible with that. I mean, you're all presumably adults. I mean, we're not here to sort of monitor you in that way, but we are tracking attendance. But we're recording the video so you can watch them later too. We understand that 12:30 on 16 weekdays might not be ideal for many people, so we'll be flexible with that. JD put that link out there again. We had some questions. I answered a good one. It was about with the we have some Topstep questions I've seen too that I'll go on. I answered someone's question about like where does like the 50K in buying power went. And I think this is an important thing because it ties into what you talked about today with leverage.
Mhm.
It's not so since it's day trading at Topstep, right? 50K is not the maximum amount of contracts you could put on via day margin. 50K you could probably put on, 100 ES or something. That would
Bad
be,
idea.
oh, terrible idea. But the way I do it is, so if you think about the value of an ES contract, it's about 4,700 right now, right? So 50 times that times 5, which is the contract size you can put on the 50K, comes out to about 1.175 million in nominal exposure. And you wouldn't want to trade that sort of leverage unless you without a 50K in room. At least I probably wouldn't even do that. But if you think about that, so like 50K represents under 5% of the nominal exposure of your full size, and that applies to the other size accounts too. How to watch yesterday's recording. Once again, JD posted it in the chats, and it should be in an email you received. Yeah, we're still running live at 7:45 Central, 3 p.m. Central for the forecast and recap, where Hogue will go through the charts and talk about the stuff that day. And then on Tuesday at 11:30, we get together and just talk about something, a topic like we did ranges today. So, Hogue, if you don't mind, I'm just like rolling through some of these questions to ask.
No,
We won't be able
please
to
go
get
ahead.
to all of them. Why do we require traders to be flat at 310? That's Hogue. Maybe you can answer this as well. I want to speak right, but I believe that has to do with margin requirements and best practices. So if you're day trading, I could tell this from my experience in my career too. If you're trading outrights, which is what our traders are doing, you don't want to be messing around with the end of a day. That is a low probability trade right there. Hogue, do you have anything to add to that?
Well, yeah, the New York Stock Exchange basically closes at 3 o'clock. So there's no underlying commodities that are open. All of the other products in regular trading hours are by all sense closed. You see the volume drop off in gold at 1 o'clock. You see the volume drop off in the currencies at 2 o'clock. You see the volume drop off in the S&Ps typically after 3 o'clock. Crude oil 130. Most of the longer time frame traders have finished what they were going to be doing, and the opportunities after that 310 kind of cutoff aren't very good. And if they are, the liquidity that we just talked about is going to be a lot smaller, and you run a bigger risk if something happens and it goes against you. We don't want anybody getting stuck in any positions, of course, while the market's closed. So it's the reason it makes sense to me. And it helps us get the trade reports to you a little quicker as well.
Yeah. A few more on here. No, it shouldn't be. You can't lose more than your margin at Topstep. Simplify. Someone asked like that the idea of leverage is still unclear versus margin. The way to think about it is if you are holding something that is worth more than the cash that you have, that is leverage. So like if you go out there and buy, say you have $50,000, if you go out there and buy $50,000 worth of, I don't know, Google stock, right? The most you can lose is $50,000 if it goes to zero. Now, if you have a $50,000 account and you're holding $1 million of Google, now you're on margin, because if it moves just 5% down, so it goes both ways, right? If it goes 5% up, you have just made a lot of money. That's the thing of leverage. The bad news is if it went down 5%, it would completely wipe you out, because you will have lost $50,000. Right. So if you can lose theoretically more than what you have, that is leverage. It's just like amplifying I think we call it like the rocket fuel of trading, but
Mhm.
it gets abused all over the place. Best way to set up a paper trading account. I think there's all sorts of. I mean, yeah, I'm hesitant just to like. I don't want to give a bunch of companies free advertising, but you can set up pretty cheaply free paper trading accounts at places.
Yeah,
Like
they're dime a dozen.
they're dime a dozen. Yeah. Yeah, some people are making some good comments in the about like leverage and things like that. What's the relationship between liquidity and volatility? Yeah, they're more or less. So as volatility increases,
That's a great
liquidity
question.
will go down. So I guess they're inversely proportional, really. The market will thin out. You'll see it like set up your ladder sometime, your trading ladder, and watch what happens at the unemployment number at 7:30 Central on the first Friday of the month. As
Mhm.
that number is about to happen, you'll see all the orders drop out because there's about to be a huge amount of volatility going on. You know, it'll go from 100 on the bid, 100 on the offer to just little contracts all over the place.
Mhm.
A ladder is when you are trading. It is where it is your depth of market. It's where you actually enter the trades. It shows the offers at each level of price and the bids at each level of price, and where they come together is where the market's trading.
Here it is. It's on the screen right now.
Oh yeah, so yeah, that's what it looks like there.
This is the dome or the ladder. These are prices. These are actual bids and actual offers. Now, this is just when I took this picture.
Yeah, it's in a PowerPoint now, but
Right. So it's going to be moving. But like Jack says, if you're going to be looking at the market when, let's say, FOMC meeting comes out, S&Ps are going to have, 1 to 10 contracts on each bid or offer. So you're going to have a lot less liquidity. So that was a really good, insightful question about if volatility is greater, is liquidity lower? And typically, yes.
yeah. And Igor, why liquidity is good? The reason we want to trade liquid markets is because you can get in and out of them at roughly the right price, or the price that you think, right? If you see a thick market like this, you notice that you can get in and out of it at the bid and offer there. If it's liquid, say you have 100 contracts out, we'll make it easy, something like that. If I can trade all 100 of those contracts right at the next price, that's great. I can get in, I can get out. I know my risk. Now, if that market's really illiquid, right? You're going to have a lot of slippage. You don't know where you can get out. It's very risky and can be very dangerous. And that's how you see when you see hedge funds blow up or stuff like that. Oftentimes they get trapped in illiquid products where there's no bid or offer, and then you are SOL,
Yeah,
as
you
they
could
say.
say the flash crash was one of those situations. All the bids dried up. There was not one bid. So you're going to have to continue pushing price down until you find one.
So it's possible because why why can you hold more than it's worth? It's because I'm trying to think of the best way to do it. The same way that when you're trading, you can sell something you don't have, right? All these markets rely on promises and contracts. Show me. I'm looking at the feed, Mario. If you copy paste your question again, I'll do it. Um, where were we? So like that's why you have a margin, right? Uh, if you go further than what you lose, right? You will get what's called a margin call, which is bad news bears, right?
You don't want that.
Yeah. Hope maybe you could talk about the margin call, and I'll take a look at what the other questions were.
Sure. There was actually a couple that was with Topstep for a while, and they had some money. They put $100,000 in an account, and they picked a product, and they maxed out as far as the leverage they were allowed to whatever product they bought. They didn't even look at it. 2 weeks later, they looked at it. They were up $400,000 on $100,000 trade. Okay, they had $100,000. They put max position on. They got lucky and they made 400,000. They took the profit, looked at another chart and said, let's try this one. put max leverage with $500,000 on that. And within a week, the market had taken all that money and then some, and the phone rang. They got a phone call that said, "Hey, this is your clearing firm. If you want to maintain this position, you're going to have to come up with some more cash." They didn't even know what a margin call was. And that's when they figured out that leverage is dangerous and it can be, something you certainly want to be paying attention to. They were a very nice couple. After that, they came to Topstep to try and figure out how to actually trade.
Okay, I'm going back to the other one over here. These are Topstep questions. So Mara's question was one more question about Topstep. After you pass both challenges, how sure is to get funded? Do you accept? I don't understand the last sentence of the question, but yeah, if you pass both the levels of the trading combine, then yeah, you're sure to do it. Unless, I mean, the small caveat would be that if you were somehow, I'm not saying this like cover lawyers ended, if you were somehow abusing the simulator through like an algorithmic thing or something, maybe. But like, yeah, if you pass both steps, we don't
there's no
discriminate how you did it. Yeah, there's no subjectivity. So is the ladder the only indicator of liquidity? I mean, it's the best because you can just see it, but
volume is also
volume. Yeah, the number of trades that occur in a day is a good indicator. I mentioned in there like the treasuries is probably like 10-year treasuries will have probably the biggest volume on the CME. Am I right about that, Hogue?
Yeah, and I think the dome shows like 1,000 contracts plus on every bid or offer. Very liquid.
Not a super fun, if you're just outright day trading, maybe not the most fun market, a little tough to understand sometimes. That's what I used to trade when I was at the prop firm doing spreads. Do you think it's safe to start with micro futures? Yeah, I mean, start as small as possible. I mean, whether you're going to the Topstep or micro futures, start with paper trading and then move to micros and then move to minis. If it like, or just stick with micros. But yeah, micros are much safer than it gives you. If you just have a little money to get started, it gives you a lot. One E-mini future or something is a lot of risk, really, right? So definitely start with the micros. And if it works there, bump it up. I mean, the downside, there's no free, they're completely fungible. 10 micros equals one E-mini. But I mean, if you get to the point where you're trading a whole lot of them, the CME's got a feed, so they your commissions will be higher, right? The commissions on trading 10 micros is a lot higher than trading one E-mini. Is there an indicator to show the change in open interest? Yeah, I think you just plot out the open interest, right, Hogue, and then you can see what the changes are.
On most platforms on the quote board, there's usually a field that you can add that will say open interest, but it's only for that contract month. You can find open interest also on that CME group. I'll show you.
To clarify why Hogue's looking at this, someone asked, so with leverage, you can only lose what you have or you be in debt. Well, if you're in a brokerage account, if you're using leverage with real money in a brokerage account, for instance, you indeed can lose more and go into debt. You can have a margin debt, and that's when you get a margin call, which means you have to put up new capital to cover that, or they'll liquidate your positions.
Liquidate you.
I've never been, I don't look at these things too much, but I presume like what happens, like if you can't meet it, do you get like sued, or is the broker's probably generally just out of luck if you can't pay it, but it's going to make your life not pleasant. So I would not do that.
Yes.
It's probably going to ruin your credit. I've never done the retail end of this, but yeah, like a loan from the bank. You don't want to play around with margin calls.
No. And it's not like, on the trading floor, there were, people that had clearing firms that backed local traders. And if they had a local trader that had a bad day or a bad week or something, and they were down money, a lot of these owners of clearing firms had become acquaintance or even friends. So they would let them trade their way out of those situations to a point. There are those that never able to work their way out of those. And it's a small group of traders. We had a trader a while back that still owed money to a clearing firm. So he was, we were unable to fund him because he owed the industry money.
Not a good place to be.
No.
And Andre asked an interesting question. Why can't the platform close their position before more margin calls necessary? They could. Now, people don't always want to do that. It just depends on what the features of an account. So theoretically, like if you really believed in a position, you should do it yourself. Or if you work for a firm, for instance, they would certainly liquidate your position before you were in for a margin call. But it's just one of the features of a margin account. They're not inside your head, so they don't know what you're trying to do. And for all they know, you may want to hold this position and just add more capital because you believe in it. Should you do this? No. Yeah, it's totally possibly funded. Wait 1 second. Sorry. Is it possibly funded Topstep trader outside of US and Canada? Yeah, I think we've funded people from like 100+ countries or something. I think unless you live in like North Korea or maybe a few other places, we're good. Yeah, and the reason, Darren, they do that is because it's a day trading account. So they don't want to assume that risk. They'll liquidate you for sure. Yeah, is India available, Hope? I believe it is.
Pardon?
Do we fund traders in India?
I believe so.
I think so.
So if you have a quote board, here's open interest for February crude. 208,765. That's as of the close yesterday. However, crude oil rolls over every month. You get a little bit ahead of me here. We're going to be talking about open interest in coming days here, but this is the bulletin, the daily bulletin. It's Monday, January 10th. Says preliminary. I'm going to refresh the page. Now it's final. So this is the 208,765 for the front month. But when we look at how deep the product is, there's open interest all the way 5 years out, 10 years out. So I tend to look at the total open interest, which is down here. I'm going to make this a little bigger here so we can all see it. But this bulletin gives you settlement price, net change, volume, net volume, open interest, net open interest. It's a really good tool to use. And again, it's on the CME website. Just type in bulletin and it'll say daily bulletin, and you can get all your information on all your products here. Here's the mini S&Ps, all the equities. Let's see what the open interest is in the S&Ps. 2,306,955 overall. It's a lot of ticks.
Yeah, I see two more like last questions. We gotta run pretty soon, and we'll be answering questions after all the classes. So, let me just check this real quick. I might get, I can't tell if I'll get trouble for revealing too much here, but I'm just gonna do it. Dave says, I understand Topstep seems micro and mini contracts the same, so you can only have 5 mini contracts or 5 micro. How does that make sense when at 50? We hear you. That's something down the line we're trying to correct. We understand they're fungible, but that has to do with our, it has to do with a lot of technical things involving our entire back end of our trading system and our deals, with the brokerages and stuff like that. It's not that we don't see that, like, we wish we could do that and we're trying to fix it at some point. It's just right now, technically it's difficult for us to do. So we'll try and resolve that at some point. Once again, the recordings are in that email that we sent. And then JD, if you're here, could you post that one more time down there? And maybe somebody asked about, like, they missed about the attendance again. I'm tracking it just because I love tracking everything. I'm a trader, but like, don't worry about it. You guys are adults. If you have to miss classes, you have to miss classes, but it's good to be here so you get your questions in. Last one, why is settlement price important in the analysis before market opening? Hogue, tell us.
Sure. Settlement price is the price that the market is marked to. So when you look at the settlement price in the S&Ps, let's say, here, hang on a second. That's where margins are marked to. Here we go with margins again, right? So one of the most important things I think about the settlement price is what happens in the overnight. So this is gold. This is the 30-minute chart. This is yesterday's settlement price right here. We see the market moving steadily higher throughout the day or throughout the overnight session. And as we get closer to the regular trading hour open, a lot of those longs that have moved price that far up are starting to get nervous. They're saying, okay, we're probably not going to be able to continue this move to the upside after the regular trading hour opens. So they start to get nervous and they bring price sometimes all the way back down to settlement. So settlement is, here's another one. Overnight, they got too long. They got nervous before the open and brought price back down to settlement. So settlement can be a target in this regard. It can also be an opportunity to look for an execution for a long if the market is in the right market state.
Excellent. Okay. We have like one last question about rollovers and stuff like that. But, I presume you're going to cover that in a later course. But generally, as a day trader, you shouldn't have to worry about rollovers. Just trade whichever month of the contract. This is good advice. Look at the volume look at the volume, right? For your product, whatever you're trading, if you're trading oil, there'll be a number of months. If you're trading stocks, a number of months. Just trade whichever one has the highest volume from the day before, and you won't go wrong. Keep open a calendar, right? Like Ninja Trader has a trade desk calendar that has rollovers and stuff like that. Be aware of when they are, but just always be careful if the volume seems low, right? Always trade the one with the most volume.
And you can always come check it out on the market forecast, because I'm always telling people we're in rollover. We're going to tell you when we're rolling over. It should be a good idea for you then.
All right. Well, Hogue. Yeah. So guys, if you want to ask more questions, we'll be doing it after each and every one of these classes, but also feel free to join Hogue in the morning or Dan in the afternoon, and we'll try and answer as many questions there as possible. I hope you understand with all these people in here, we can't get to everyone every time, but we'll try our best by the end of this to get everyone's questions. So have a great day, everyone. I'll let Hogue sign it off.
All right. Thanks, Jack. Thanks, JD. And thanks again to all of you. Tomorrow, we're going to take a good look at the TS Trader trading platform. We're going to look at how to pull up charts, how to change charts, how to change time frames, how to look at the dome, how to place orders, how to place stops, how to place bracket orders, how to open up your quote board, how to set up your quote board. We're going to get the whole kit and caboodle set up for you tomorrow at 12:30. I look forward to seeing you then. Again, hopefully you enjoyed today and had the opportunity to learn something. I look forward to seeing you on the forecast tomorrow, 7:45 Central. Until then, trade well, be good. Take care now.